Mr. Chairman, to strike the last word.
The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I strongly oppose the underlying bill and support the proposed amendment. Earlier today, we had a long discussion about one portion of the bill that dealt with women, infants, and children, and the way in which the legislation inadequately funds their necessities for them for both women, pregnant women, infants, and children to lead and to have healthy lives. We're now on to another issue that is extraordinarily important. In the 90s, the idea of deregulation took hold and was expanded throughout the 2000 to 2008 period, so much so that we had the financial meltdown. We had Wall Street bankers and hedge funds running wild, gambling on the future, and America was the great loser in that gamble. Over the last several years, we've seen the derivative market increase from $30 to $40 trillion notional value to over $300 trillion notional value today. Every day, across the Wall Street tickers, across the wires, and in the back rooms of the hedge funds and the big banks, $300 trillion of risk is traded back and forth. Risk that is not backed up by assets, but bets that are made. It's the great crapshoot in the alley of Wall Street. $300 trillion. Where's the money? Where's the enforcer to make sure that the bet against Greece, the bet against the price of oil, who's going to back that up? It's not there. It is the shell game of all shell games. There are no assets. I was the insurance commissioner, and we understood a couple of things very clearly, and that is, if an insurance company was going to make a bet that something would go wrong, then they had to have the asset to pay if that bet ever came to pass. That's not the case here. There is no regulation of this market. Understanding the need for this, back in the 1930s, the Commodity Future Trading Commission was established to make sure that if bets were made on the future price of grain, somebody would be able to pay if that bet had to be paid off. Worked okay until the great period of deregulation. We are now learning. Let's understand the definition of insanity. It's when you repeat what you did before and expect a different answer. This bill is asking us to once again repeat the deregulation of the derivative market by defunding, not providing adequate funding, Commodity Futures Trading Market, a commission. We are betting that things are going to work out, that there's $300 trillion of notional value out there in the derivative market is somehow going to work out okay. We learned in 2008 and 7 that it doesn't work out okay, literally collapsing the entire financial market of the world. Okay, speculation, let it rip. We did that once before. It is insanity to assume that this time it's going to work out okay. This amendment puts back in the necessary money for the Commodity Futures Trading Commission to adequately regulate a huge market beyond the imagination of all of us. We need this money. We need the systems in place to make sure that this derivative market is adequately regulated so that we do not once again find this nation bailing out or falling into a great recession and depression yet again. No, I don't think so, because I suspect I'm pretty much out of time. Let us understand what is at stake here. It is the very nature of our economy to be able to survive in an era of rapid speculation that has driven up the price of oil. We know from Goldman Sachs, we know from the CEO of Exxon, that some $20 of the $100 per barrel oil price today is speculation. We can take a look at the other markets. where speculation is also running rampant, and it is the Commodity Future Trading Commission that is specifically under Dodd-Frank required to rein the excesses of this market, to end the speculation, to ultimately make a rational market out there for the futures market. I yield back my time.
Gentleman yields back the balance of